I'd like to start by introducing my esteemed panel. Peter Hambro, who many of you know, cut his teeth trading gold on COMEX a few years ago, and is now the chairman of Petropavlovsk, a 600,000 ounce a year gold producer. We have Dominic Frisby, a well-known journalist and now TV star as well, who has been commenting on gold for years in the public arena, and also is a well-known expert on Bitcoin. Angelos Damascos, fund manager of a small-cap gold fund, and John McGloin from Amara Mining, who has discovered one of the best new discoveries in 10 years in West Africa. So I'm going to kick it off with the most pertinent question in this room, given the last 5 years, and we'll start with Mr. Hambro. What, in your opinion, is the largest factor affecting the gold price, and where will it be pushing gold in the medium term?
Jim will go around.
Thank you, Amanda. Well, as one of the scumbags that the previous speaker was talking about, I'll try and answer it. The thing that amazes me about the gold market at the moment is that actually there are two of them. There is a huge physical market, particularly in China and in India and amongst the central banks. Vast amounts of gold are being shipped physically out there, and the Shanghai exchange has delivered almost 80% of the world's annual gold supply to its retail customers so far this year. And on the other side is the derivatives market. And there's such a gigantic amount of money in the hands of money managers that doesn't know where to go. What a great idea to go short. I don't know what I'm doing here at a bears conference anyway, because I don't believe that's a sensible thing to do. In COMEX, the New York Commodity Exchange where gold is traded, there's approximately 1 ounce of gold for every 200 ounces of gold that people have sold. So the potential for a major explosion in the gold price, I think, is huge there. But it is definitely, and you saw it on Friday, imagine selling $1.9 billion worth of gold on the Friday between Thanksgiving and the Thanksgiving weekend. I mean, if you want to manipulate the market, that's the way to do it, guys. It's absolutely wonderful. And that's the problem that we, the gold miners, are having to live with. But once the ETFs, the money has been shaken out of the ETF gold orchard, and that the potential for going short on the back of that is gone, I think we'll see the price go back to something like normal. If you look at the marginal cost of mining gold at the moment, it's probably more than $1,100. So there are an awful lot of people, luckily not us, who are really struggling at this price. And the supply from the world mine supply is going to go down. As long as China, India, and the central banks in the world don't mind stopping buying, the price will stay low. But if they continue to want to buy, the only way is for the price to go up.
Dominic, do you have an opinion here?
Yeah, I think it sounds ridiculous, but the biggest thing affecting the gold price at the moment, in my opinion, is the trend. And we're in a bear market, and the trend is down. And trends just go on. They just go on for a long time. And sometimes they go on for, decades. And so it sounds ridiculous, but we need that trend to change. Now, what's going to change that trend is sentiment and narrative. Every bull market needs a narrative. It needs a story. And, the .com, for example, the internet's going to change the world, had a great story. Gold, commodities in the noughties had a fantastic story. Asian buying, the new Chinese middle class, all that stuff. And gold in particular had the addition on top of the whole Asian buying narrative of this thing of central banks debasing money, there's too much debt, we're going to have a crisis, fiat money's going to collapse, all the stuff that we all know, and we're going to need to start using gold as money again because gold is honest money and the monetary system is corrupt, all that kind of stuff. And that story's just kind of gone now. And it just looks, in the face of a price that's just constantly falling, it just looks stupid, almost. It doesn't look believable anymore. And so somehow, gold needs to find a new believable story in order to reignite a change in sentiment. And so what is affecting the gold price? I'm going to say narrative and trend. The bottom line is it's a bear market. In a bear market, prices fall. And as we all know, bear markets can go on for a long, long time. And there is no vested interest in there being a gold bull market again. In US stocks, there is a vested interest in them going up. In the UK housing market, there is a vested interest in it going up. So it receives all sorts of protection and subsidy, all sorts of, there's none of that with gold. I'm not saying that gold is manipulated lower, because I kind of don't buy that. But sure, you get ridiculous, you get bear raids, and those bear raids tend to happen when the market is thin, such as yesterday. But that there is a deliberate conspiracy to suppress the price of gold, I'm less sure about. But I do know that there is no vested interest from the powers that be in getting the gold price up. So something needs to happen. Maybe it's a crisis, maybe it's just a change in sentiment. I'm going to just put an idea out there, and I don't necessarily believe it, but I think it's worth thinking about. And there's this idea that gold is money, it's the money of last resort. Well, and that, you know, Asians still understand gold and they're still buying gold. But if you look at what young Asians are buying, sure, it's because they haven't got as much capital, but they're also buying much more lower carat gold, particularly in India. They're not buying higher carat stuff, they're buying lower carat stuff, because it's more about the bling than it is the kind of the store of value. And the other thing I'd consider is, you know, until maybe the beginning of the 20th century, the horse had been used in transport. It was essential to transport. It had been essential to transport throughout all history. And then new technology came along, and the horse, now, it's pretty much redundant. And why is gold any different? Why is gold not as redundant as the horse is? Because money is tech, and tech has moved on from gold. And sure, gold has a role of store of value, but as money, I think its role might be as redundant as the horse is. I don't necessarily believe that, but it's an idea I'm putting in your heads to kind of question this kind of gold is the money of last resort narrative that everyone is obsessed with.
Angelos, do you have any ideas about what might be the catalyst that changes gold against Dominic's doom story?
I agree with Peter that there is an explosive, potentially, situation in the physical against the paper market that could easily change the dynamics of the gold price. And I agree with Dominic on his thesis of the trend. We are in a bear market, unquestionably. People don't want to be in an asset that is falling. It's the old adage of trying to catch a falling knife. And I think I also agree with the thesis of the vested interest. The Fed doesn't want to upset the global markets. The central banks continue to pump liquidity whenever there is some sort of an unrest in the system, therefore supporting the kind of assets that financial investors like and driving them away from assets like gold. Until something might happen that could change that, could change the ability of the central bankers to control the situation and even cause them to withdraw liquidity from the market. And that's something that no one can really tell when it might come. And the purpose of gold, in my view, is the insurance value in one's portfolio to have some cover just in case the unexpected happens. And when the markets go in a tailspin and we have massive corrections, such as what happened in August and September with the Chinese market rout, gold is likely to outperform all other asset classes and provide some comfort to your portfolio.
John?
I think, you know, what Angelos is saying, I think, is exactly right. I think in the short term, you know, what's become accepted in the market, or what appears to have become accepted in the market, is that the gold price is all about where the...
Is your microphone on? Sorry.
That what has become accepted in the market, or appears to have become accepted in the market, is that the gold price has been driven by the Fed and where you know, and by the strength of the US dollar. So the Fed at the moment appears to be talking about lifting the rate at some point in December. But if you look back, there was an article I read recently by a guy called Adam Hamilton, and he looked at all of the, since 1970, he looked at all of the movements in the Fed from 1970 through to today. And what he found was that if you graded those, the increases, there had to be 3 consecutive increases as a significant rise in interest rates. He found that there were 11 increases in rates between 1970 and today. And in 6 of those cases, when the rate went up, the gold price climbed as well. In the other 5, the gold price fell. In the case where the gold price fell, it fell from a high. And overall, in the average of that fall was 13%. The average of the rise was 61%. The last 2 times that the Fed raised the rates, which was between 2004 and 2006, June 2004 and June 2006, the Fed raised the rates, I think, 10 times at that point, and they raised it by 425 basis points. And at that point, the gold price went up by 50%. The time where they raised the rates before that was in 2000, and I think they had 17 raises, and it went up. It went up 175 basis points at that point, and the gold price went up 5%. So the accepted idea that the Fed increasing the rates, a strong US dollar, is going to be the end of gold because gold is an unyielding asset, is, frankly, I don't buy into that. And I think what will happen, what will be the catalyst, is that we see that the Fed doesn't, that an increase in the Fed rate doesn't kill gold, and that removes that block, and that we then see gold build very slowly thereafter. So in the short term, I think there may be a little bit more weakness, but as that all falls out, I think you'll see gold price start to climb.
Great.
Do you think, John, that they actually can afford to raise rates? I mean, if you, the little sums that I did showed that a 0.25% rise in bond yields in America would wipe out the Fed's balance sheet completely.
Absolutely right. I think that they
can't afford to, but the job of the Fed is not to drive the market. The job of the Fed is to stop volatility. But what they appear to be doing at the moment is creating volatility. So they keep talking that they're going to raise the rate, they're going to raise the rate, and I think that they need to do something small and then step back. But it'll have to be small, very small. It won't be the rate, that rate increase that you saw the last time, 425 basis points. 25 basis points is about the most they can do. And even that, as you say, I think, you know, they're dicing them with affecting the rest of the market. And as Dominic said, you know, money flows very easily at the moment. So money flows into those parts of the market where you're going to get a return, and you've been getting a return in the stock market. A higher interest rate environment will basically pull the rug out from under the stock market, and you'll see a falling stock market, and potentially the market the sector that has underperformed the most in the last 2 to 3 years has been the gold sector and the mining sector. So I think that you know, you'll see a stronger gold price, and that will drive the mining sector if they have the temerity to go out and raise the interest rate.
It seems to me that interest rates are their lever, and right now they daren't pull it. So they keep telling you they're more interested in the perception. We're going to do it. We might do it in December. They said the same thing in September, and they're going on.
Well, same as OPEC.
Yeah. I mean, it seems to me that the chances of that actually happening are relatively low. But that's what's helping this whole. I totally agree about your view about the trend. I mean, when I was in the industry, we used to say, "Let the trend be your friend," and that was the way you made money in the commodity business. But the way that the vast amounts of money in the derivatives industry, in the managed money industry are swirling around and can go in anywhere. The fact that they're short these effectively tiny markets is terrifying.
Yeah, I mean, but I would agree with that, and I think the Fed does need to raise rates by a small amount just in order to save face. But the idea that we're going to get rates at 2 or 3% or something like that, it's just not going to happen. Zero interest rates are the new normal. Coming back to this story of the COMEX, there's undoubtedly a huge amount of leverage there. I mean, a vast amount. It's a fractional reserve system. But this story that the COMEX doesn't have the gold to deliver and there's going to be a massive short squeeze, I mean, it's been doing the rounds for, I don't know, 10 years or probably even longer. And it just doesn't happen. And one day it's going to happen. But as an investor, you can't bet on some kind of anomalous event because you just got to go, you can't do that. And I mean, I own, for all the bearish sentiment, I still own some gold miners and I've still got a vast amount of physical gold. And I know that one day, and I hope that day is sooner rather than later, that gold is going to be worth a great deal more than it is now. But just in terms of ordinary day-to-day investing, betting on some kind of calamity is, you know, the probability is not on your side.
Well, a comment that I would add to yours, Dominic, is that it is not the time to try to trade the gold market because it is so unpredictable and so difficult to read which direction is going to take.
I don't think it is difficult. It's down.
Yeah.
I mean, couldn't be clear at 5 years of down. It's down.
But the point I would make is that if one was to develop a position in gold via either bullion or equities or ETFs, it has to be a sustainable position. It has to be a position that you can afford to keep for a long time without being concerned about the actual price and the book market value. And at some point in time, if we are right in our thesis, it will come to your help when everything else crumbles. It will be your insurance against the unexpected.
Based on that line of thought, if you do believe you need a bit of a hedge in gold and you have a conservative sentiment in that some money is wise in gold, where would you put it? Where is assuming that the market will turn eventually, because it always does, do you put it in ETFs? Do you put it in gold miners? What kind of gold miners do you put it in? Do you put it in bullion? What is this spread of investment that you would be looking for to get that gold hedge?
It depends very much what your objective is. I think the best argument for owning gold is it's the fact that it's nobody else's promise. You don't need to worry that somebody's going to go bust because of it. Having some and making sure you have it physically and you have control over it, there's no point in putting it in the bank because you haven't got a key to the bank vault. I'm serious about it. You should just have just a little bit stacked away somewhere, hide it away, and that is what I call wealth insurance. It's not a speculative hedged way. It's just there. I mean, and if you pray God it doesn't happen, but if you find yourself having to be a refugee somewhere, it's definitely going to be better for those guys who've got the gold than the ones who haven't.
On the subject of junior miners, which some of our panel know very, very well, they have arguably been the most battered of any miners or any companies on listed stock markets. Who's going to go up first in a rising gold environment, and why? Well, Angelos?
Unquestionably, the people who have stayed in business, because there are so many companies going bust at the moment, and it's the product of the bull market of 2000 to 2011 that money poured into the gold mining industry without any regard of valuation or fundamentals, just on the hope of the blue sky potential, the huge upside, as it's called in the industry, mineralization open in depth and on strike. That was a common theme of all fundraising in the gold space. And people believed it at face value and poured money in it. And now it's all coming back. It's all being unwound because so many of these projects had a very high marginal cost that are now obviously uneconomic. So in my view, as an investor, you always have to take a view on the timing. And in times like this, when we have experienced a 5-year bear market, perhaps investing in bullion might be much more stable than investing in equities, in gold mining equities. But will it give you the return to cover your previous losses? Probably not. But by investing in a gold mining company that has sustainability, that can stay in business even at a lower gold price environment, you stand the chance of benefiting from the operational leverage. When the gold price starts rising, the market capitalization of your investee company is going to rise by a multitude of times. And I think the reality is that the companies that will stay in business are those that have a reasonable, sustainable cost base, perhaps even below than $1,000 an ounce, but also have this operational flexibility. They have the resource models that once the gold prices start rising, they can accelerate their mining processes and they can revise their plans to increase production and benefit from this rise. And that, I think, is crucial, is staying in business in today's environment.
We have a couple of miners on the stage who have managed to stay in business. What do you think, as management of gold companies, what do you think? You've seen some of your compatriots survive and do well and some do badly. What do you, other than just low costs, what do you think are the differentiators that people in this audience might want to look for in the management of mining companies?
I think that only looking at our own experience, the people that you want to favor are people who don't get carried away and waste money when things are good. And that's definitely something that there's a huge temptation to do. When we first started, we had no money and we repaired everything and nothing was wasted. When we were sailing along with huge margins, we didn't. We were lazy, and it's come back to bite us. But we've managed to turn around the business pretty well, and we've got our costs now down, sustaining costs below $1,000. It's a hard and difficult thing to do, and it's not as much fun as it was. But those are the people that I think you really need to do. But on the other hand, I think people haven't realized how important the mining and processing of refractory ore will become, because worldwide the supply of new oxide, easy to process deposits is evaporating. And people who have managed to overcome the problems of processing refractory, or whether by using BIOX or pressure oxidization or roasting or whatever, those are people who are in the long term, and I'm talking about investments for my grandchildren rather than for myself, those are the people who are going to stay in business in the gold market.
John?
I think what Peter said is absolutely right. I think that, strong management is absolutely key, and management that doesn't buy into its own bullshit, to be perfectly honest with you, that questions everything and, doesn't overpromise, stays, plays within its means. I mean, what we've seen in the industry over the last few years, the gold industry has been pretty bad actually at giving a return. We've seen, huge amounts of debt, not just in gold, but in the rest of the mining industry, and that in this environment has really come up to bite people. So I think, understanding what you've got, and also, like companies that, Angelos said that, having the ability to expand. I would argue that going too much, expanding too far, and dropping your grades and mining out every last piece of gold at smaller and smaller margins is really what drove the gold industry into the situation it's in now. So, when you look at across the gold industry at the moment, and you look at how they're calculating their reserves, whatever about the resources, the reserves, many people are calculating those reserves above $1,200 an ounce. So there's going to be write-downs coming if the gold price doesn't go up. So the key thing is to look at your reserves and ensure that your reserves are being calculated down below 1,000, I would think, and then move forward with that. So you basically hold your margins today, but you'll hold your margins as the gold price rises. It's a really, really tough industry, and trying to tell people that you've got millions and millions of ounces is one thing, but you've got to be sure that those ounces retain economics in a low gold price as well as in that whole gold price environment. So I think management teams that do that are the best. And if you look across the industry, there are only a handful of them that have done that have, ignored, analysts and ignored the market clamoring for more and more ounces and have stuck to what they know, what they do really well, and have basically are among the strongest teams out there today. And the one that I would say, if you want to look to see how a company should be run, you should look at Randgold and the way that Mark Bristow ran that company right from the start back in, as the bull market took off early 2000. Other people were saying that they had millions and millions of ounces. He very, very slowly built his ounces up. And today, I think he's got a very robust company that has weathered a very, very difficult market.
Dominic, you were going to say something earlier?
Yeah. At the gold price at 150, 1,000 to 150, there's a huge amount of support there on the basis that there was a huge amount of resistance at this price on the way up. I think it took about 3 or 4 years to get over $1,000 and several attempts. And so I think I hope it will find some support at this price. But like I say, it's a bear market, the trend is lower. And what happens if it goes through 1,000? It's probably going to go back to 850. Now, what mining companies can survive 850 gold? Not many. It's only the low-cost producers and those that have been clever enough to hedge at a higher price. Now, I can't believe I'm saying that. In the bull market, when mining companies were hedging, everyone mocked them. But now if somebody sold gold at 1,500 or 1,400 or 1,300, or even if they hedged a load of gold on the rally we had last month, those guys look pretty clever. So I'm not sure to what extent hedging has returned to mining, but I think we're going to, in order for companies to survive, we're going to have to see a bit of that. But when the cycle turns, it's always the way. The low-cost producers are the only ones that survive. They'll be the first. So they'll be the first to rise, along with those kind of exploration companies that don't actually spend any money on exploration, if that makes sense. They just sit there with a load of kind of mineral banks, if you like, and just sit there with a load of deposits and keep their costs down and wait for the market to turn. Then as the cycle gets going and the gold price starts rising, then the development projects come into play. The higher cost producers will start putting their mines back in, because the old thing of you just need the gold price to rise by $100 or $150 for somebody's profits to double, or for a mine to become economic. And then at the end of the cycle, we'll see all the silly exploration companies. And I call them silly. That sounds really patronising. I don't mean that. But you know what I mean, the small caps. And the projects that they're touting as the bull market develops will become more and more silly, put it that way. So that's the way that the cycle will go. But for now, if you want to buy gold, you've got to buy. I mean, I wear some around my neck. I bought some coins a few years back, and I was so sick of just watching them doing nothing. I melted one of them down and got a jeweler to design something. I wear it around my neck. But yeah, so you want some physical gold, and I think you only want to be buying miners that can survive. And you've got to think, is the gold price going to 850? Can this company survive a gold price at 850? Then maybe it's a legitimate investment. But if you think that mining company can only survive if gold stays above 1,000, well, then you better have an exit strategy in place if gold goes below, because they're going to struggle.
Now, there is a fair bit of consensus. Over the last 30 years, we've had 5 bull markets and 4 bear markets. And gold is massively cyclical. How long those bear and bull markets last is a matter of contention, but eventually the pendulum seems to swing a great deal in in gold's favor. But the difference in this particular bear market is the question of whether or not the dollar is still the benchmark to gold, because Aussie and Canadian miners are actually doing extraordinarily well. Aussie index miners are up this year because they're producing in lower Australian dollars. Is it still appropriate to use the dollar as a benchmark for gold? Does anyone want to kick off with that one?
I'll start, and then, I mean, you're absolutely right. The Aussie producers have done well this year. The Canadian producers, some of them have done well, but actually they've done nothing like as well as the Aussie producers. But that's because there's all sorts of issues with Canadian mining that still need to be sorted out and flushed out. And you're absolutely right, though, when your costs are in cheap local currency and your profits are in US dollars, which has been strong, then you leverage that. But yeah, I think it is right. The dollar is the global reserve currency. It's going to be the global reserve currency for the near future. Gold is thought, we all, even though we're in the UK, we still look first at the dollar price of gold. So yeah, US dollar strength is going to be a factor. But if you look at gold as another currency, and gold is maybe weaker than the US dollar but stronger than the Aussie dollar and so on, then it doesn't matter so much.
Peter?
If you're in China or Russia, gold has been a fantastic investment. And about 70% of our production costs are ruble denominated, and thanks to the performance of the ruble, that's made them halve. So I think that probably it is wrong to look at gold purely against the dollar. The American gold market was very big and very important, and I was involved in those far-off days of supplying it with Kruger rounds, because that was one of the ways that you could get gold into America. Now it's all going to China, and to a lesser extent to India, and the people who have bought physical gold there, with the lowering in the value of the yuan and the rather perilous state of the Chinese stock market, they're looking terrific, and there are an awful lot of them too. But because their newspapers are printed with Chinese characters, not in English, it doesn't make much headlines over here, and we're still locked in some sort of old-fashioned situation. So I think we should look at the worldwide performance of gold as an investment.
Given that for most of the people in this audience, buying gold in renminbi or rubles might be a little bit difficult, are you suggesting that maybe the access is that you go through the miners to get access to them and those margins? You're in this space, Angelos. How do you get access to the higher margin companies?
Well, I think the dollar will still be the predominant driver of the gold price, because that's what the financial investors look at. And I think the panel probably will agree with me that the financial flows today drive the direction of the gold price. We have these massive ETF flows, we have derivative instruments, paper, etc. But when we look at the mining business, when we look at investing in a miner, we have to look at the business dynamics. We have to look at their input costs, we have to look at their labor costs, we have to look at what price they sell their output at. And this is where you have to differentiate and look at the domestic currency dynamics. And in that regard, the Australian miners have been great beneficiaries of this massive devaluation in the Aussie dollar. And it provides them fantastic sustainability on their business. So looking at investing in a gold mining business, you have to look at the domestic dynamics. You have to look how this business is shaping up with the currency situation. But we must never forget that a business is not always driven by the currency dynamics. For example, in our view, one of the bigger risks of investing in a gold miner now is that you can see that they have lowered their operating costs, they have lowered their sustainable costs, but in effect, what they are doing is they are high grading. because there are two ways you can improve the profitability of your business. One is to decrease the input and labor costs. The other is to try and increase your output price. So by processing the higher grade tons, you receive much more income when the cost of processing is similar to processing a low-grade ore. But what that does is that it alters the economics of your mining plan. When they produced probably their feasibility plans several years ago, looking at different price levels for gold, their engineers developed their block model and decided which regions to mine first. And now they are changing that. They are addressing the higher grade zones, which in effect cannibalize their mine life and place the rest of the resource at risk of being uneconomic.
I think I'd have to disagree with you there. Mm-hmm. We've been accused of high grading now for about 20 years. And it's amazing how successful we've managed to do it. Because if we'd high graded, we'd have nothing left. We started with 1 million ounces of 1.5 million ounces of resources, and we've now got 23 million and have produced 5 million ounces of gold, 5.5 million ounces of gold in the meantime. It is possible to manage this thing, and one of the arts of gold mining is to balance the grade. That is the real thing. And there's a very good argument right now to produce as little gold as you possibly can, mm-hmm. because you're selling it so cheaply, and it's better to leave it in the ground where it can't be stolen unless it's stolen by the government, mm-hmm. And much better to cut back production, frankly.
Are you doing that?
Not quite.
It's tempting, though, isn't it?
Yes.
Yeah. I don't disagree with you, Peter, but I think it also has to do with the mineralization, with the type of ore body that you are mining, and how you approach the mining operation. Not two mines are the same.
I agree. You can sterilize low grades easily, and so as I say, the art of doing this is to get that balance right. But you can still mine the high grades without doing it. It is possible.
Mm-hmm.
All right, one last question. I'd sort of like everyone on the panel to take a punt at it. The difficult question. We all know that nobody knows where the gold price is going and over what time scale. But where do you think the gold price is going? What direction is it going, and over what time scale on a very general basis? Do you want to kick that off, Peter?
Over a 3-year horizon in US dollars, I think it'll go up.
Okay. Come on, Dominic, let's go.
Over the next 3 years, in US dollar terms, the gold price will range between, we'll see a high of $1,200 and we'll see a low of $850. There's a precise prediction for you.
Angelos, what are you forecasting at?
I've been long and wrong for far too long to make a prediction. But one of my favorite presentational slides, which I'm going to use later on when I talk, is a slide prepared by Goldcorp, who is one of the world's largest producers of gold. They produced 2.7 million ounces last year. And they show that the peak discovery rate for the industry took place in 1995. And regardless of the massive increase in exploration spend during the bull market years from 2000 to 2011, we did not manage to find sufficiently large amounts of new ounces. And they reckon that the peak production of the gold industry is happening this year, 2015, and from next year we are going to experience sharp declines in production. And I think that makes sense if you consider the huge crunch the financial markets have imposed on the gold mining industry and the scarce availability of capital to invest for developing new mines. So it's not unreasonable to think that if something happened and financial investors returned their interest to gold and the sentiment changed, that this increase in demand might be met with sharply reduced supply. And from there on, we all know what happens to a commodity when supply is short to demand.
Excellent. John?
I mean, my view is I think that there's a little bit more weakness left in it. I don't see a low of 850. I don't actually see gold. I don't believe gold will pierce 1,000, and I think that in the nearer term, much closer than 3 years, I would think there might be another 6 to 12 months to play out in this market, and I think that the gold price will start to rise. And I think a lot of it depends on what the accepted talk is around the Fed, and as that all starts to shake out, I think that you'll start to see the gold price come up. So I would think a high, I don't know, I think maybe 1250, 1300, and a low of 1,000.
Great. All right, we're going to need to wrap up a bit because we have a number of other speakers coming up. I'd like to thank the panel. Before we jump off, is there anyone that has any specific questions for the panel?
I gotta go.
Yeah, I just have one question for the panel. If gold is not seen as money or as currency, why do central banks around the world hold tons of it?
Very good point.
Barbaric relic has some place. They should just sell all of it so that the ordinary people of the world can buy it at low prices. I just wanted your thoughts on that.
I have exactly the same view. I spent a long time supplying gold to the central banks. I know. Sorry, why are the central banks buying it if it's
not money,
barbarous relic and not worth anything? And it's extraordinary how much they are buying it. And I think that's the biggest bull point, in fact, for the whole thing. Sadly, I'm going to have to run.
Okay. All right, we're going to
I can answer that question. The answer to that question is why are central banks buying it? Partly, as Ben Bernanke says, tradition. They always have. They were laughed at for selling gold during the bull market, and they don't want to make that same mistake. They want to save face. And it is an asset that it has value and is nobody else's liability, and therefore has a role to play in banking. That doesn't make it money.
Excellent. Thank you all very much. Angelos will be speaking later this afternoon, specifically with tips on how to invest in gold miners. And John will be speaking right after this on Amara Mining.